Good morning, everyone, and welcome. This is Investing 102. Our instructor for today is going to be Miss Leah Hall of How Money Works, and she is going to be teaching us about some realities, some concepts, and some strategies. Thank you for registering for Martin Business Solution, our master classes. Don't forget to go to the website. We have plenty more upcoming, and classes are being added weekly. I am just so excited that we're in a season of learning. We're going to be some sharp people by the end of 2021, 2022. We are going to just be soaring high. So I'm excited. And so I just want to give a quick announcement, and then I am going to get out of the way and let Ms. Leah have the show. I want to make sure that everyone is aware that the AK Legacy Foundation is sponsoring this class. This is a nonprofit organization where we thrive on financial literacy, business development, and we also offer disaster recovery services. And so don't forget to go to our YouTube channel. You see it right down at the bottom of the screen. You can go to aklegacyfoundation.org and just read all about the awesome things that we're doing across the communities, all across the nation, not just limited here to our home office here in Louisiana, but we are so thankful for all of our friends all across the nation. All right, so I have Miss Leah. She is going to be taking over the screen, and we will have Q&A toward the end. So if you have a question, put it in the chat. And if you're watching the replay, shoot us an email. And so Miss Leah, it is now all on you.
Thank you so much for inviting me, Candy, this morning. I really appreciate it, and I do not take this invitation and opportunity lightly to speak into the lives of people about their money and how to treat it with respect. Again, AKA Legacy Foundation, thank you so much for inviting me and sponsoring this event. I'll just get started with a little bit about me. I am a full-time school teacher, actually, and I love to teach. I've been teaching over 20 years, and it's my passion, it's my calling. And I have made a huge money mistake, and I'm laughing now because I've recovered through money coaches, mentoring, getting my life back together financially. And, you know, going through that whole process, I realized it is a lot of people who just don't know how to handle their money, what to do with their money, that whole process. And so I just went out on a mission to eradicate financial illiteracy, and I connected with a company that matches my values, which is the How Money Works company. We're educators first to help make informed decisions. Now, right here, you can see on the screen that there's a QR code. This is how you would schedule an appointment with me. You can just kind of take a picture of it or use the QR code and set that, fill out the survey, and you would be able to do that. Also today, we're going to talk about financial concepts, and we're going to talk about types of accounts and strategies and the next steps. What do I need to do to become financial literate, at least a little bit, for, you know, today in investing. So rules of engagement. I do want this to be a participation event. Take some notes, go ahead and get pencil and paper, get in a comfortable place, you know, get you some coffee. And this is a judgment-free zone. I'm not gonna criticize you because I've made financial mistakes as well. And so this isn't something where I'm going to say, oh, you did it wrong. That's just not me. That's not my style. I think once you know and understand, you're able to do better. Sometimes we just, you know, don't know what to do. So if you have a question, as Ms. Candy has said, go ahead and put it into the chat, text, email, call us so that you'll have your questions answered. So this is the How Money Works company that I've partnered with, and we are educators. We've been on TV. We have a book that we like to give our clients to make sure that, again, that they're financial literate, to make better informed decisions. And just wanted to say that if you want a book, I actually will be able to send you one. I have a few, and I think Candy's through her foundation may also have a few as well. But like I said, it's written by two gentlemen. One is Tom Matthews and Steve Siebold, and like I said, they've been on several outlets, and again, it's a wonderful company. We educate first. So how do we educate the community? Basically, we teach realities. Now, I know a lot of people want to talk about investing and doing a lot of different things, but for the majority of Americans, it's really a subject that we want to learn more about. We just don't have that confidence to make those decisions. And so we teach in where are you? What kind of investments do you want to do? And then we teach about different concepts of money, and then different strategies. How can you start the process? So in that process of what we do, we have 7 money milestones. And I know you're saying, well, I thought this was about investing. It is about investing. But what we do before you invest is you got to get your house in order. You have to have a foundation of financial stability. And that's what we teach, is that before you can start investing, what about your debts? Let's just say you start investing tomorrow with as little as $100, which $100 is not little, but let's just say $100 a month, and you start investing, and an fortunate event happened. I mean, we're in a pandemic, COVID happens, and you're no longer with us. Well, after 6 months, you only have $600 saved. So we believe before you invest, you should have proper protection of your income and your assets. Proper protection is life insurance. And that's a very important foundational effect, because once life insurance is in place, if something happens 6 months from now, your family has that entire policy at their disposal instead of just the $600 you saved. So it's important that you understand the foundations, getting rid of your debt. I mean, do you want to leave your family with all of that debt and then your $600 account that you just started in investing? That doesn't balance out. That's just not sound financial advice. So we look at your entire picture. We want to cover all of our bases. Yes, you can start investing, but we also want to have some other things in place so that you have a clear, comprehensive financial picture. And just to get it out of the way, you won't write me a check. We're paid by product providers, and the product providers, they're in business to make money, and we just don't add any other financial additives to the funds that you're trying to create for your family. So, those people that are in business, they're either going to pay for a Super Bowl ad, a 1-800 number, or a financial professional. So this whole process of sitting down with me, I am a financial professional, as I said before, is a complimentary process to just put everything out. And typically, if you go to other companies, they'll charge about $200 to $500 for this same comprehensive plan. So just to let you know again, I'm in it for the education, understanding, how money works so that you can make informed decisions about your money. So what is investing? We are here. We have started class. Investing is having something of value to gain income or appreciate over time. And you may be saying, well, I already knew that. Well, hey, we're at 102. I just want to give you that definition to make sure that you knew what that was all about. And when you think about investing, a lot of people say, well, this is an investment, or this is an investment. The bottom line is you've got to answer the question, is this an asset? Is it growing and appreciating in value over time? Or is it depreciation or devaluing over time? And that's really the main question that you're trying to ask. So the financial industry is a regulated industry. And the regulatories are FINRA or the SEC. I'm sure you've heard of that. And then they even have state regulators. So it is an extremely regulated industry. And to become a financial professional, you do have to be licensed. So what is the stock market? I'm going to tell you what it is, and then I'm going to kind of give you different analogies to help you kind of relate to it. So stocks. Stock market is a trading or regulatory, like I said, industry where you have different assets and things trade in that market. Okay. Index. You've heard of indexes. An index is an S&P 500 or the Dow Jones. You've heard of that. Those are an indicator of how healthy the market is. And of course, you'll always see this disclaimer: past performance is not a prediction of future results. So I don't want you to be afraid of the stock market. There's nothing to be afraid of. Like, it's just a way of handling your money, and we'll get into it later. The analogy I like to use, like I was saying before, is fire. Fire can be bad. I mean, I would not want to be in California with them burning up all the houses in the tree. Like, that's horrible. But fire, when you're cooking marshmallows and in the fireplace, is good. So the stock market is not supposed to be scary, but you do have to handle with care and keep it in the right place. So this is a picture of long-term stock market from 1930 all the way to now, 2020. And what you can see are there a lot of green ups, even up to 30%, 20%. Like, it's the stock market interest rates can be really, really high. But then you also see the red at the bottom. You can also lose money. And so again, fire in the fireplace, good. And we'll talk about, what is the stock market, how we do it, and the best way for you to go about being invested. So let's look at these investment terms. Fiduciary. A fiduciary is a person like me and my company where our point is education to the client, and we put that person ahead of our own interest. So my company is a fiduciary company, and we are licensed to help you with your financial picture. So again, we're regulated by FINRA, the SEC, and the whole industry. Suitability. Suitability is kind of like, it takes into different factors, like your education matters. If you are a sophisticated investor, I can offer you more things than someone who's just starting. If you're just starting, then there's certain conversations we're not going to have because it's not suitable for you. Talking about age. If you are an older person getting ready for retirement, I'll talk to you about certain things that I won't talk to a 19-year-old about, or vice versa. So suitability has to do with, is this product correct for you? Is this something that will help you? Risk tolerance, huge, huge, huge. What is your risk tolerance? So some people like to gamble. Some people, you know what, if they lose $100, it doesn't even matter. Like, they're very high risk tolerance. Certain products they could do, whereas you like, you know what, I don't want to lose any of my money. Can I lose nothing and still invest? And yes, we can help you with that as well. Your risk tolerance will give you access to certain products. And again, I mean, some people say, well, you invest with no risk, no rewards, but there's different things that you can do to be invested, but also have the safety. So your risk tolerance matters. So, and then also your goals and dreams. If my idea of retirement is one thing and your idea of retirement is a different picture, then your goals and your time horizon will be different, okay? So I've said a mouthful. I don't want this to just to be me. Like I said, I want to participate. So, I just want to kind of pause and see, Ms. Candy, do we have any questions? Does anybody want to comment?
Okay, so this is what we'll do.
Go ahead.
If you have a question, raise your hand. That way I can just unmute that particular person one person at a time, because we are recording so that we may be able to share this information later. So we wanted to have a good quality. So I appreciate you all. You can either put your question in the chat, You can raise your hand if you're saying, well, how do I raise my hand? Look down by your controls where you can mute and unmute yourself. There should be a little hand raise option. If not, just put it in the chat and I will unmute you if you have a question. And then of course, toward the end, we'll even have an open discussion where we are able to dive in more. So if you don't have a question so far, that's great. Just stick around, make sure you're taking notes. And as Ms. Leah mentioned earlier about the book, if you want a copy of the book, send us an email. It's in the chat. I'll put it in there again. That way we can partner with her in assisting you all to get the book because you are tuned in here for on this Saturday morning. So Ms. Leah, I don't see any questions. Let's see, I don't see any hand raised. And if you have an organization that you would like for us to present live with, maybe in a more closed setting, let us know. I'm sure I can tie Ms. Leah down a little bit longer and get her to continue to share with us. So thank you all for tuning in this morning. Ms. Leah, back to you.
Thank you so much, Candy. And again, all of those things at the top matters. Whether your financial professional is a fiduciary, whether they have to put your needs first, whether the product is suitable for you, your age, your risk tolerance, and then your goals. So I just do want to take a moment out, again, get some pencil and paper, and I want you to think about your goals. Why are you here? Why do you want to invest? And go ahead and put in the chat because I want to know my audience. I don't want to just keep talking and you already know all this, or keep talking and you're wondering, you way back on slide 5 and I've moved on. So I definitely want you to participate. And the first participation is kind of explain, why are you here? Why do you want to invest? And just put that in the chat. Is it for short-term goals, or is it for long-term goals? Is it for retirement? Is it for to start your emergency fund? Your purpose for investing leads you to the right direction. And that's where we help you. We guide you along the way. And again, our purpose is for education. So let's just start with the stock. What is a stock? So you have different companies, and if the company is trying to raise money, they will offer shares. You become a shareholder and you purchase stock. So the best way I like to explain this is this: you're buying a car. So you bought a car. I don't know what's your favorite car. You can put in the chat, what kind of car you like. Let's just say, I don't know, a car, BMW. Okay, I don't know. BMW, and it is a 2018 BMW, and you really like it, and you paid, I don't know, $40,000 for it. So once you own the car, let's say you've owned it for a couple of years, and you want to now sell it. So once now you're trying to sell it, you want to get paid, let's just say $35,000 for it. Well, when you start putting it online or wherever you're going to put it in the market to sell, nobody's paying you $35,000 for this 2018 car. They're not. So that's the point of the stock market. It is a trading market, and you can only sell your ownership for what someone is willing to buy for it. Now, there's a lot of other technical terms we can get into. The evaluation process of the actual business and corporation, like how stable of a company it is. You got, blue chip, which is the higher, more stable companies. And then you have growth companies, you have small companies, you have large companies. It's different types of companies, different types of investing. There's different investment strategies. Like, are you going to be a fundamental strategist where you're looking at the profit and loss sheets of that business? Or are you going to be an analytical analyst where you're looking at the growth of that stock over time? So it's a lot of things that go into it, but our purposes for today is just to understand the basics. A stock is ownership, and it trades in the market. What is a bond? Same kind of thing. Let's just say Walmart this time. So Walmart, and on the stock market, they don't go by their full business name. They have what's called nicknames or ticker symbols. And so Walmart wants to expand. Oh, let's just say they want to build another Walmart. like they need another Walmart. But anyway, I'll just use that one. And they don't want to go to a bank. They want to get money, raise money, but they also don't want to increase their stock. They don't want any more, no one else to have ownership. So they're going to go to you. They say, hey, can we borrow $10,000? Borrow. So bonds are loans, and it is a fixed interest rate at a fixed time, and it's a bond. Like, you know, people say my word is bond. It is an actual guarantee of a certain payment at a certain time with certain interest. So if they borrowed $10,000 from you, and they said it's 5% on this bond, in 20 years, or however long the term is, in 20 years, they're going to give you that $10,000 back. But what's the point of you getting $10,000 in 20 years? They pay you interest over time. And I did forget to mention that stocks give you dividends, which is a percentage of their overall profits. So you can make money in the stock market, like we already talked about. You can make interest from bonds. 5% interest on $10,000 is $500 a year. So you get that interest per bond that you own, or dividend per stock that you own. Okay. Well, y'all tell me if y'all have questions, but that's basically what stocks and bonds are. So let me do another example. Mutual funds. Mutual funds are basically like they sound. It is a pooled investment. So it's 9 of us here. Let's just round it off for easy numbers, 10. We all pool our money together. You give $1,000, I give $1,000. Everybody's giving $1,000 to this pooled investment. 10 people, 10 times, $1,000 is $10,000. So we get a manager to manage our pooled investments. Let's say we get Karen. Karen is going to be our manager, and we're going to pay her 2% on this pooled money that we all came together and said we want to do. Well, Karen, like, you know what? My favorite artist is Beyonce, and I'm going to go ahead and kind of put money into her record label company, and I just love her so much. Or, if we put in, let's just say, I don't know, who else is going to be our manager? If we get a different manager and we say, let's just say Phyllis. Phyllis is going to be our manager, and she loves beauty products. So she's going to invest all our money in KKW Beauty. Well, hold on. I don't want to invest my money in Kardashians. Okay, fine, whatever. Point is, they can't do any of that. The manager has to follow the prospectus. And the prospectus says, it's like the rule book. It tells you how the money will be invested, what sectors, what bonds, what stocks. In a mutual fund, again, it's just all of us putting our money together, and it can be a stock mutual fund, stocks and bonds. Like, the prospectus says how these funds will be spent or invested. Okay. So it's not an individual stock. It's a bunch of different companies. So what is an ETF? ETF is similar in the fact that it is a lot of different companies, a pooled investment, but it trades like a stock. So it trades throughout the day. Whereas a mutual fund, the price of it is not determined to the end of the day of the stock. So these are basic vocabulary or concepts of how the stock market works. It is a market where people purchase and sell stocks, bonds, mutual funds, ETFs, different types of investments. Okay. I'm gonna look in the chat. I don't know if we have questions. All right. So let's just keep going. So after you have the types of investments, after you have your goals, now let's talk about types of accounts. So in your types of accounts, some are invested in the market and some are not. So for instance, type of account, liquid. There are reasons to have a bank account. like for your direct deposit and you're trying to take money in and out. So liquid is cash. What is your cash value? That's a bank account. Savings account is also cash value. So they, again, you can put money in a savings account. You have immediate access to it. Money markets. So in a bank account, I don't know if you've ever seen your bank account where you get like 25 cents, ooh, interest payment. Your bank accounts can give you interest, very, very little. Savings account may give you a little bit more interest. The next level would be a money market account. I'm not sure if you've heard of that, but that's also a diversified kind of investment where it's in a lot of different companies, but it's really low risk short term because they wanted to have a little bit more interest in a bank than a banking account or a savings account, but it doesn't have as much interest as if you didn't want it to be liquid, like if you weren't about to use that money, you know, soon. So then you have CDs. CDs is another account, but it's kind of like a savings account, very little interest. So all of these liquid accounts have low interest rates because they're not meant for long-term investing and growing your money. Okay. Retirement accounts. Retirement accounts have stocks, bonds, and mutual funds in them. The difference between these types of accounts are how they're taxed. So a lot of retirement accounts grow tax deferred, meaning that you're not paying taxes right now. It may come directly out of your pay stub before you pay taxes, before you have it come to you. Some of this stuff is taken out. So 401k is, again, a retirement account that you actually cannot touch. It is illiquid or not liquid. You cannot touch it without tax and penalty before age 59 and a half. So these accounts would be 401k, 403b, 457, IRA, annuity, SEP IRA. So all these ones at the end are for like businesses. When you own your own business, if you don't have any employees, you would get one of those SEP IRA, simple IRA, solo 401k. You would get one of those. If you do have employees, then you would get one of those other accounts. So we can help you set up your business retirement plan depending on if you have employees or you don't, your risk tolerance, how much you want to contribute. Like, it's a lot of different factors, but all of those are retirement accounts and you cannot touch them before 59 and a half. All right, they're also what's called custodial accounts, and this is for minors. So if you want to start investing money for your children or investing money for your grandchildren, if you have grandchildren already, you would get them a custodial account. 529, if you know, you've heard of that, that's for investing in college. And then UTMA, UGMA, that's for any benefit to the child. So it has to be a benefit to the child. You manage it, but the benefit has, any distributions have to be for the child. Another account, permanent life insurance. A lot of people don't know that you can grow money, cash money, in a life insurance policy. And there's different types of policies that you can do this with. So your cash value can be in the market, on stocks and bonds, mutual funds, or it can grow with the market, which is index. And I'll explain that a little bit more in a second. Individual brokerage account. A brokerage account does not have the penalties or delay that you have with a retirement account. An individual brokerage account is money that you can put there, have it appreciate, have it do capital gains. And again, in the brokerage account are stocks, bonds, mutual funds, ETFs, whatever you want to invest in. So these are the types of accounts. And again, I'll look at chat to see if we have any questions. We get to set the age to withdraw for the kids' account. So you manage the account until they are of age, because, you know, kids cannot go into contract because they're minors. So you have control over the account until they're, and depending on your state, it's either 19 or 21. But that's the thing. After you have grown all this money, unless you put the money in a trust, they have access at 19 to 21 years old, and whatever they want to do with that money, that's what they can do with the money because it's for their benefit. So if you want to still control it after they're, you know, of age and they can put it in there, then you have to have it, you have to plan for that and put it in the trust. All right, let's keep going. So those are types of accounts. That's what's in the accounts. Now we're talking about what are some options. How does your money grow? Glad you asked. It can grow fixed, like we talked about with the CDs, you know, 0.5%. Your money is growing in a bank account, savings account, mutual fund, but it's set at a fixed rate. Variable, you're in the stock market. And remember, I showed you that picture where the market can go up, the market can go down. So when it's up, you're making a whole lot of money, and when it goes down, you could lose it all. And this kind of goes with your risk tolerance. If you don't want to lose any of your money, then you may not want your account to grow variably. You may want it to grow a little bit safer, which is the index. So your money can grow index, meaning that you're not in the market, but your money is growing with the market. So you don't participate in any of the downward downturns. So it locks your amount, your principal amount in at the height. And as it goes down, then you don't participate in the downturns. Your account only grows. Now, because of this, of course, a lot of indexes will cap your growth or your gain. And so that's the benefit of why a company would do that, is because no, you don't participate in the downward part, but you don't totally participate in the total up. So let's just say they cap it at 10%. So your money is growing consistently at a 10% interest rate. But it's a safe, if like I said, if you don't want to lose any money, then you don't have to participate in that. Does custodial accounts have to be from parent or guardian? So a custodial account does not have to be from the parent or guardian. It's just like I said, it's a designated person who is investing for the child, and anybody can contribute. So even if the parent is the owner of the account for the benefit of the child, like for birthdays, I think that's a great idea. Birthdays, like if they give in $100, you can stick that into the account, or you can do what's called dollar cost averaging, where you're consistently putting money in that account. Let's just say for chores, if they earn, $20 a month, then you can consistently put that money in that account. So let's talk about the power of compound interest. Now, we did this in the 101 account, but I just wanted to revisit it because a lot of people don't understand, well, how does that money grow like that? It's the difference between simple interest and compound interest. Compound interest is interest upon interest, meaning if you have a principal account, like your initial investment, let's just say it grows, by 5% 1 year. So again, you should have pencil and paper, calculator. Let's just throw a number out there. Let me get it. Hold on, sorry. So let's just say easy numbers, easy math. Let's just say you have $1,000 account and it grows at 5% interest. So it'll grow to, you'll get $50 a year, okay? So $1,000, $50 is $1,050. Instead of it growing $50 every year, your next interest payment will be on the $1,050. So $1,050 times 5% is $52. So I know I'm saying like small numbers, but it grows on the principal plus the interest. And then the next year, that total value, it'll grow on that again. So compound interest is growing every year because you're taking the interest on the total value of the account. I hope I explained that well. If not, again, ask me a question. We can do more examples. So what is the rule of 72? Beautiful thing. It gives you a kind of a idea of how your money is going to grow over which amount of time, depending on your interest rate. So you would take 72 and divide it by the interest rate, and that tells you how long it takes your money to go double. Now, this is an example from the book where you have Zoe. She's 19. She got $10,000 of inheritance, and she's like, I don't know what to do with my money. So some of you may have money stashed here, stashed there, and you're just not sure what to do with it. Zoe was in a similar, place, but she decided she was going to put it in the bank at 1%. Well, she put it in the bank, and her money's not going to grow until she's age 67. Why? Because 72 divided by 1 gives you 72 years. So her money's not going to double and grow. So let's just say 3%, she put it in as a money market account. She did 3%, and it's only going to grow 72, again, divided by 3%. It's only going to grow twice. So it'll double at age 43 and then double again, and she's 67 and she only has $40,000. Now that's not bad. Her money grew, but 3%, maybe not. Maybe you don't want it to be liquid. Let's go all the way down to 12. The interest rates matter. Again, calculator, paper and pencil. Put 72 in your calculator. Then you're going to divide by 12, and it doubles every 6 years. So at 19, she had 10,000. But by the time she was 67, she had $2,560,000 from this one-time investment because she put it in a higher interest rate. That's how your money grows. And it's really important that we understand that. Now, listen, she didn't touch the money. She let it grow. So here we were talking about the banks, and here's just some list of certain banks. None of them are paying you interest rate above 1%. So again, the bank account's purpose is not for your money to grow. It's actually losing money because of inflation. Here's another example how the rule of 72 can work in the other way too. You may be saying, well, I'm 50, like this example is with May. She's, wants to grow her money and she has $500,000 saved. Well, if she, has 10 years left before she wants to retire, 10 divided by 72, she needs at least a 7.2% interest rate. So this is a way that you can kind of also calculate what's the basic interest rate that you need in order for your money to grow. So I wanted to do this example. Some of us have old 401ks at other jobs, like you may have changed jobs and you had an old account at a different place. Well, if you leave your money there, then you don't know how they're taking care of your money. Say your money is not really growing, not really doing anything. The needle hasn't moved. And you're like, I thought, this is a 401k and it's supposed to invest for my retirement. Well, if it's at that older company, you don't really have access nor control. So if you roll that money over into a place where you do have control, where you can control the investment, I'm sure that you would make sure that it is actually growing. So again, 72 divided by your interest rate, 12%. Look at how much you'll have in just a short amount of time. You can have over $400,000 because you took it seriously, you rolled over that old money, and you helped it to grow. Investing, again, is a mindset. You have to take care of your money in order for it to build and grow. You can't expect it to grow if you don't even know what's going on. So how do you build wealth? I saw a couple of people wanted to build wealth for retirement. I saw some people wanted to do things for their children. So how do you do that? That's a good question. First of all, a lot of times it's not about how much we make. It's about how much we can save and invest. How much of it do you keep from taxes? So what are some things that threaten our building of this wealth? Well, procrastination. If you don't get started, like I said, don't be afraid of the market. The market is not scary, but you do have to take care. You do have to educate yourself on what you're doing, know your risk tolerance, know your suitability, like factor in all of those things, but you have to start. You cannot wait. Procrastination it's not good. And you already know. Losses. You have to protect yourself against losses. Inflation. Inflation's a thing. I know you remember probably, early 90s, different things cost differently than they do today. The dollar today will not buy and purchase the things of tomorrow. So inflation is real, and then taxes. Remember, we talked about the taxes of those accounts are different. So the impact of losses. I'm not sure if you remember where you invested in 2008, and I don't know if you saw all those red lines going up and down at the beginning. The stock market can crash, can be negative, and it doesn't always grow. Sometimes you can lose money. And so in that, if you lose money, look at this example. 50% of $10,000 is $5,000. So half of your account is wiped out, just like that. You lost all that money, half of it. Well, in order for your money to grow back to your original investment, it doesn't grow by 50%. You think you lost 50%, so you gain 50%. That's not how that works. Think about it. 50% of $5,000 is only $2,500. So that doesn't replace your account balance. If you lose 50%, you need 100% to get that back. Okay, so losses are important. So now we talked about mutual funds. A lot of people invest in mutual funds because it goes with that old adage of, not having all your eggs in one basket. Whereas if you buy an individual stock, you have what's called business risk. So if that business goes under or lose value, or if stock isn't trading at what you purchased it for, you're losing money. Versus if you do a pooled investment, or if you get, professional help, then your money can consistently grow. So diversification is, again, having maybe stocks, maybe bonds, maybe mutual funds, like having it spread out. So if something goes left, you're not totally wiped out of your account and your holdings. Taxes. Candy can jump in at any time about taxes, but guys, taxes, you're going to pay them. That's what we pay. We pay taxes. Unless you have tax strategies. So let's talk about some tax strategies. 3 ways your money's taxed. Tax now. We kind of talked about that a little bit. We talked about a tax now account is your bank account, because when they deposit that money, they already took out those taxes from your payroll. So tax now is a CD. They really don't make a lot of money. Tax now is your brokerage account as well. If you have capital gains, or if you have dividend payments or interest payments, all of that you're being taxed on. So those are tax now accounts. Your brokerage account is a tax now account. Tax later. Tax later means that it is deferred, a deferred payment, meaning you don't pay taxes now because they took it from your check before they gave it to you. So those are your retirement accounts. Tax never. There are also tax never strategies. I had never known about those strategies until, I started educating myself and learned more about the tax never accounts. So this is the way taxes impact your money. And the question you have to ask, do I want all of my retirement tax deferred? Meaning I pay taxes on the growth and the distribution. Or do I want a little bit in each bucket? Because it's a difference in paying the seed tax versus the harvest tax. You know, taxes on $10,000 is different from the taxes on $100,000 after it's grown. So just want to make sure that you're knowing that. Again, let's go a little bit deeper into taxes. So the taxable accounts, like I said, that's money that's already been taxed. It is your bank accounts, CDs, your whatever you invest. Like if you have an individual brokerage account, if you have those capital gains and they send you the little slip that says this is how much you earned this year, you pay taxes on all of that. Qualified retirement plans. Again, if you have one at your company, if they're giving you a match, which is free money, definitely you should be maxing out your 401k plan up to what they match it to. Because if they're giving you 3% and you put in 3%, again, that's money growing that you did not have to contribute. The thing that you want to think about that is sometimes they have what's called vesting periods. And so if you haven't been with the company long enough, you may not qualify for that matching. Or if you leave the company before you are vested, then you may not have that money as well. So a qualified retirement plan, you cannot touch it before age 59 and a half. When you take that money out, it is taxed. So tax deferred or tax later depends on the taxing rules whenever you get ready to take it out for retirement. So what's an annuity? I'm telling you guys, annuity sometimes gets a bad rap, but it depends on what are you looking for. When I heard that you could have payments for life, it's kind of like, you know, they use this type of strategy when they do the lottery. Like, I don't play the lottery, but you know how they say income for life? That's an annuity. So it just depends on where you want your money, how you want to be taxed. And again, these are tax later strategies. So red is tax now, yellow is tax later. I'm gonna look at the chat to see if we have any questions about this.
Ms. Leah, we do have a question.
Okay.
Wanted to know, they may be older in age, never did any savings or investment or retirement or anything. Is it too late for them to start anything?
No, not at all. And we have, again, different ways, depending on your whole scenario. And I have a couple of examples that I'm going to show. And then the example that we just had with the 50-year-old having, you know, 25,000 from an old 401k, they were able to roll that over. But take that same thought. If you start saving now, the question is, how much do you have to save in order to have enough in retirement? And that's a different answer for everybody. What does enough mean? What are you trying to do? And so definitely it's not too late. And we're going to go through a couple of more examples to kind of see how can your money grow. How are capital gains tax determined? Does your income affect how much tax must be paid on capital gains? Candy, did you want to take that or you want me to answer it?
You're good. You can answer it.
Okay. So here, I am going to answer that question. I do want to go over a couple of more things. So just to finish this tax conversation here, when you have a government bond or municipal bond, this is where you get tax advantages. So you don't have to pay taxes either to the government or to the state, depending on what kind of bond you have. So this is an option as well. Also, a Roth IRA. A Roth IRA is paid with already taxed money. So when you've already taxed it, any money you put in there, they don't tax you twice. So the distributions on a Roth IRA is tax-free. So if you don't have, again, different accounts or different ways your money is taxed, you want to plan for that whole tax average. Tax now is the red, tax later is the orange, and then, the yellow, and then we have green, which is tax never. Another one, like I said before, with the permanent life insurance, if you, it's again, after tax dollars. So any money you put in there, that tax growth is tax free. and you can actually get that money out of your policy. Now, this is a long-term strategy, so it's not something that you put in tomorrow. You get a life insurance plan and you take it out the next day. That's not how that works. These are long-term strategies, and you just have to figure out what's going to be best for you. So one of the questions was, how do you create generational wealth? And in that, that's an excellent question. First of all, if you amass a lot of money, or you're planning on it for your, generations to come, and you have all this money, the statistics say that it's lost in the next generation. And a lot of times that's because they don't know what to do with that money. So yeah, you saved all this money, but they didn't know what to do with it. All they knew how to do was suspend it. They didn't continue to invest it. So you have to start teaching the younger people, younger generations, whoever you're leaving it to, how this money should be handled, and learning different things you need to learn. Also, if you have a will or a trust, while you're alive, you set up the rules to how you want this money to be handled. And it's done by a trustee. So it's somebody, that can direct where your money goes. If you don't have a will and a trust, or if you don't have a will, then they don't know what you want to do with all this money. So how do you create generational wealth? First of all, you have to plan for it, teach them what to do with it, give them directions on how to do it with this trust. And then on all of your accounts right now, you should have beneficiaries. I don't know, again, until I got educated, I didn't know you could put a beneficiary on your bank accounts. You need to put a beneficiary on all of your accounts. Here's the gotcha. I know you may not want everybody to know where your money is. Again, you can put it in your will, you can put it in your directives, the information that they need to get upon your death. So they don't have to know all your business and where all the money is. But you definitely don't want money to go back to the state, or money to go back to whatever company, because no one knew you had that account open. So you want to put beneficiaries, you want to plan it out, you want to have everything written down. And then, like I was saying before, you can start investing today, but if if something happens next year and all you've been able to save in investing is $10,000, they're going to get $10,000. Not immediate.
Can I interrupt you just for a second?
Yes, please.
I couldn't hold it in my seat. I was like, I got to say something. A lot of times people say, well, I don't have millions of dollars, so why should I have a will or have beneficiaries or things of that nature? As a tax professional, let me tell you the horror stories that come through. A lot of times people assume, well, because I'm married, it automatically goes to my husband, or because I have kids, it automatically goes to the kids. Well, in some states, and I'm in the state of Louisiana, the great state of Louisiana, it still has to go through the court if someone dies without a will. I'm telling you, if all your uncle has is a pickup truck and a bag of clothes, and you want to take the truck and just go trade it in, you can't even do that without a will or a plan of succession. So I don't care if you have $10 or 10 million, get a will. It's a minimum investment to keep your family from having to wait on the state. And we already know they're not the fastest. And you don't want to give any money to any lawyers, any court fees. All of that is unnecessary. And sometimes families don't know how to even navigate through that process. So that's how things get ended up going to the state. Unclaimed money or things of that nature. So I know that's a whole nother class for a whole nother day, but I just had to throw that in there. Don't think you have to have a lot of money. And if you have a lot of money, because we know a lot of famous people have died without will. So make sure you get one. So I'm gonna be quiet now.
Yes. If you have children, young children, you may think that, so-and-so is going to take care of my child. Well, they know I've already talked to my sister. I love my sister, and she's going to take care of my kids. The question you have to answer is, she may want to. She may have a huge heart. The relationship is there. But if she is barely making it and not able to take care of her own kids, do you really want to put a burden on her to take care of your child plus her kids without any directions, without any financing? That's a lot. And again, nobody plans to die unless you know, plan to die and you set all those things in place. There's also things, we have a concept called $1 Million Baby, which again, you can put money away for children and have it grow for their retirement. And you can set them up for retirement. And again, it's in a trust, so they can't access that money until they retire. So there's different strategies that you can put in place to help you build a legacy for that child. So I just wanted to, again, just state that we're educators, and our first priority is to make sure that you're doing the right things with your money through education. And I have a business partner on that I do definitely want to introduce. Marika Walker personally helped me with my finances when I made a huge mistake. He is been in the industry for over 10 years. He's a fiduciary, and like I said, that's where we put your interests ahead of ours. And I just want him to say anything that he would like to say before we move on to different examples. Marika?
Oh, great job, by the way. A lot of great information. I wish I would have learned this, when I was in my 20s. I remember somebody when I was 18, and he was white, older, he was 65, and I was working part-time, going to school full-time. And he said, Mariko, I want you to sit down with my financial advisor. Now, I had no money concept. I was financially illiterate. And he told me this, and I said, I'm 20, I'm in school, I'm in a big city. I just want to have fun. Spending money was more important to me, but I wish I was literate. And I sat down with that person at that time. So great information is game changer. But it was one thing that there was a question in the chat on the capital gains tax. And if you didn't see it in the comment, it just depends on when you invested that money. If you have invested into stocks and it's within 1 year, that money is considered short term capital gain because you invested, you didn't keep it in there more than a year, then it has a higher tax if it's sold in 1 year. So generally, when you're investing money, you want to be invested longer than a year because the long-term capital gain tax is generally lower ordinary income based on, where you are. And, Candace, she's great at, sitting down and looking at your taxes and seeing how that could affect your ordinary income, from a tax standpoint. But great information, Leah. I know the rest of the information is going to be great as well.
Thank you so much, Marika. I just really appreciate your wisdom and jumping in on that question. I did forget to answer it. Thank you. But creating generational wealth. It's so important that we, again, educate the people coming behind us so that they don't make poor decisions and the same mistakes that we made. So this is an example of, some people saying, I don't have any money and I, want to do something with what I have and get started. The most important thing is to go ahead and get started. And with this example, is for a child account or a custodial account or something that you want to start putting money away for, the next generation. Let's just say you sacrificed. I know that's a big word, but it is a real one. Sacrifice, and maybe you, don't go out and buy that purse. I don't know what your thing is. Everybody has their thing. My thing is coffee, and I have to start making my own gourmet coffee, and save a little bit of money. Some people may be shoes. Some people may be hair. Some people may be nails. Whatever it is that you're willing to sacrifice, this is a one-time investment of $300. And if it doubled at 9% going into 72 is every 8 years, then 8 years, by the time they're 16, $14,000. By the time they're 72, that money has grown to over $1 million, $1.8 million. And so that age and the time of a child is their greatest asset. And you definitely want to be looking at, what am I teaching the next generation? Are they saving their money? Are we sacrificing and building wealth for the next generation? So again, different strategies, and this is what we're going to talk about now. One of the strategies that we talked about before was cash value life insurance. You can put long-term care, add that as a rider on your policy. And in that, we're not getting any younger. If your family has Alzheimer's or something in their family where they have to be taken care of, depending on your time horizon or depending on how long your family lives, you may need long-term care. You can add that to your policy. Tax-deferred growth, tax-free income, tax-free legacy, all of that can be done. So just to give you a little bit about that, the real cost of insurance. So this is an insurance ledger. Disclaimer, this is not, predictive. Remember we talked about before, not just saying this is your scenario, but let's just say you have a policy. This is starting at age 36 and you see the cash value surrender policy. This is not for a short-term deal. This is a long-term planning period, but let's just say you've heard, by term. Term is the best one to get. It just depends on your situation. Term may be best for you, or you may want a permanent policy. Let's just say you have a 20-year term. At age 20, they're 55 years old. They've accumulated or they've contributed $44,000, but this cash value is $56,000. So even if you got a term policy with, return of premium, this cash value in this permanent policy is actually more than your return of premium policy. So this may be one that makes more sense to you to get because you have this cash value. And some policies, after your 10 years, you have access to that money. And again, this is not necessarily to get access, but at least you have money set aside where it is growing. Here at age 70, you can set it up to where you no longer pay the premiums. So you stop at age 71 because you don't want to pay your premium anymore. It's just different things that you can do with life insurance that I'm not sure people are aware of. And then look at your cash value. Your cash value is almost $200,000. Again, if you have a place that your money is, and you just need to borrow, let's just say $10,000 to, whatever it is you're trying to do, that's money, that's your money. You can borrow your money. And are you going to lend yourself money? That's on you. Another thing we can do is if you need to supplement your income, you need about $1,000 a month to supplement your income in retirement. You can also use your cash value policy to pay you in retirement. So this is just a tax never strategy advantage that you can do. So we talked a little bit about the time value of money and how it's important to start saving now. So here's an example with Sarah and George. Sarah was 22 years old and she started saving, but then she stopped. Because she was younger when she started, she actually has more money than George, who started at 30 and went on to, and he had to keep saving until he was 67, and he still had less than what she had. So that money time value is really important. Someone asked earlier, well, what if I haven't, started saving? Well, this is the importance of the time of value. Look at what you have to save per month at age 20, about $100. But by the time you get to be 45, and I'm gonna, share my age, I'm in my 40s, it's $1,000. It's really important that we understand the time value of money, to start saving now, start saving early. And even if you are older, it isn't too late. Let's look at another example. So again, I wanted you to kind of think about it yourself and try to figure out your numbers for you. But if you have a 12% interest rate, again, it'll grow every 6 years, and you decide how much money you can save per month. We look at your budget, we look at all of the things you're doing, all your responsibilities, and we carve out that time or carve out that amount that you need to save. But this example is for a 30-year-old. A 30-year-old who decides that they can carve out $200 a month, and it's just a one-time investment of $2,400 for that year, then it grew by the time they were able to retire to, $300,000. Well, if they could save a little bit more, and again, this is a one-time investment of $400, they did that every month and put it away, the yearly value is $4,800, but it can grow to $600,000. And again, look at this interest rate. Interest rate stays the same, it's 12%, but how much money you are willing to sacrifice and put away makes a difference. At $800 a month, just for 1 year, they sacrificed for 1 year and put away $800 a month, almost $10,000. That $10,000 grew at 12% interest rate from age 30 to 72, over $1 million. It can be done, but your sacrifice amount is important. And a lot of people feel like they're going to run out of money in retirement. And the big question for you is, are you going to run out of money in retirement? Because you may be surprised, again, with those 401ks and that tax deferred, taxes count a lot against that money. You have to pay taxes when you withdraw on that. So that's why we were talking about having different buckets. And so, your question may be, well, I don't know. Well, you have Social Security, you have 401k, that's maybe at your job, but then you still have to have your personal savings, and that lack of having personal savings, we got to start saving now and investing. And so what do you do to fill this gap between what you're currently saving, Social Security, and what you have at your job? The fact of the matter is, if you're looking for that work optional lifestyle, you have to start putting in strategies to help you overcome that gap, and tax efficient strategies, meaning, again, that you have something in those different buckets. And this could be a matter of life and death, because if you don't start saving now, that whole financial stress of not having saved, actually statistics say that you can shorten your lifespan because you're just that stressed. So now there are ways to create a reliable income in retirement. And again, we can show you how to do that. But what is reliable income? Reliable income means that your money is consistently growing, that you're not participating in the downturns, and you can predict, when the downturn occurs, you can predict what happens with your money. It is managed money. You're paying attention to your money. And so with those 3 layers of income, residual income, this is money that you can count on in retirement. When you plan for it, it does work out, but you have to start now with your personal savings, with your contribution to your retirement. So another strategy that we have is where you do have equity investments. And again, when you're invested in the stock market, it's a good thing. You make a lot of money, but we also talked about you can also lose a lot of money. Well, one of the strategies that we have is called RISE strategy, where you participate and you get the upside. But remember, we talked about you can also eliminate the downside and still have some growth in your portfolio. So depending on your risk is what we would suggest with strategies. And so again, we talked about, well, will you have enough? This is a conversation that you need to think about, and you have, and create a plan and a strategy. So a lot of people, don't really like their current job. Well, we just talked about a good strategy to have is to have multiple streams of income, not just to depend on your current job, but to have other ways that you're investing your money. So, we talked about ways that money can grow, but we really didn't talk about how different ways you can earn money. So some of us are employees where we get a paycheck. We go to work, we get a paycheck. We trade time for money. Another thing is to be self-employed. Some people don't want to have a boss. They want to be their own boss. So it's a trendy thing now. I want to be my own boss. Well, with self-employed, you're still changing money for time. And so you have to think about, how can I delegate? How can I spread this out? How can I leverage my time? And that's a true business owner, when they can leverage people that work for them, but then also leverage their money and making sure it's in different places and diversified, where they're getting money from different places. That's a business owner. And then today's topic was investing, where your money is making money. So these are the three different ways to earn money, or to gain money, or to get that cash flow. And this is from, I'm not sure if you heard of Robert Kiyosaki, but this is from his book, Rich Dad, Poor Dad, these cash flow quadrant. So the question is, what is your money mindset? Is your money mindset where, hopeless, I'm never going to get this together? Or is your money mindset, I've got to get this together? Please help me now. If that's your mindset, then that's a good mindset to have. You're ready to take action. Because remember, we talked about procrastination. That's an enemy of the building of wealth. You have to go ahead and get started. And so there's a massive need to educate people on their finances. And, millennials are needing that education because they're about to get that huge wealth transfer. Gen Xers like me may be taking care of our parents, we may be taking care of kids, and we need to understand how our money works so that we're not stretched too thin. We give money to our grandkids, we give money to our parents. Like, there has to be some kind of balance, there has to be some kind of release. And then baby boomers, they're like, I'm in retirement, what do I do? I don't know. So there's a lot of need for understanding how money works. And that's really our mission, is to educate, understand, to make good money decisions. And we need you. We're looking for educators. Learn more information, come and work with us to help educate families. And I just want to leave you with these questions. Are your actions congruent with your goals? Do they match? Do they line up? Am I just spending? I'm going out to eat every day. I say I want to save, but I'm still doing things that are counterproductive to my saving and building wealth. How a return can you get? Where should I put my money? What am I teaching my family? So after I build this massive wealth, we won't lose it in one generation. Those are some questions that you need to ask yourself. And here at the How Money Works Company, myself, Leah Hall, my money mentor, Mariko Walker, and the whole team, we're here to help. We help you through each of these steps, proper protection, building your wealth, protecting your wealth. We take you through each milestone. And as I stated before, you don't write us a check. The product providers pay for the services that you decide. Once you understand what you want, we help you to choose your path. And we do that called money discovery. So it's a whole process that we take you through to help you. And again, we're here to help. I just want you to take action. Don't be afraid of investing. It's nothing to be afraid of. Fire in the fireplace is a good thing. Thank you so much for asking me to talk, Candy. And I just want to turn it back over to you. This is the end of my presentation, but it doesn't have to be the end. It can be the beginning of your investment journey.
All right, thank you, Ms. Leah. So just really quick before we probably take maybe one or two questions, I want to give a quick announcement. Go to our website. If you see it at the bottom where it says martinbusinesssolution.com/masterclasses, we have more classes coming up. And of course, Ms. Leah, she's going to come back and grace us with some more classes, because now we have more questions. So that means we have to have another class. So I want to encourage everyone to do so. And I want to state that this class today was at no cost, and it was sponsored by the AK Legacy Foundation. Please go to our YouTube channel and visit our website, find out more about how we can assist you and serve you in your community and how you can get involved. We are definitely wanting to have more instructors. We want to get the information out there, because we know that if we would have known, as Mr. Walker had stated earlier, You know, if somebody would have told us this when we were 17, 18 years old and we took hold of it, we would be so much further along. But that's okay. We can start over now. So I don't want anyone to be discouraged. If you're not where you need to be, let's get a plan together. Email us so that we can link you up with Miss Leah and her team, and then we can go from there. All right, so let's take one or two questions, Miss Leah. So if you have a question, put it in the chat, raise your hand, and we'll move forward. I'm sorry, Mr. Walker, did you want to say something? Okay, he said no. Yeah, I got a feeling he could talk a lot. He's trying to be modest, but we're gonna let him make it. So do we have any questions from anyone? You have a team of people that can answer questions for you at your disposal. Take advantage of it. That is one of the things that that's why some of us are where we are because we didn't ask the question. So we have, hey, no shame, this is a safe zone. I just want the information out there. So if you have a question, let's get the question before I go to the last slide, which is going to close this presentation out. Okay, let me see if I have any hands raised, anything in the chat. All righty, so either Miss Leah did a phenomenal job and you just took a ton of notes, or you would like to schedule a offline consultation. So either way, I think it's awesome. So Miss Leah did a super job. I was taking notes. I was like, I didn't know that. All right, so when the teacher is learning, that is a great thing. So what I want to do now, I'm gonna come here, take our website down, and I'm gonna go back and make sure that everyone, she mentioned a book earlier. Hey, let me tell you, people don't give away books now. So if you want one, you have to send us an email requesting it because it is through a nonprofit organization. So we want to make sure that we do everything above board and correctly and through the guidelines, and then so that she can have her documentation that she needs. So just send us an email and we will definitely get it out to you. And if nothing else, Miss Leah, Mr. Walker, I want to say thank you guys for taking the time out of this wonderful, beautiful Saturday. The information was much needed. And as always, I want to shout out because my mom is on here. So, if I don't, I know I'm in my 40s, but I still got to give shout out to mom. Thank her for tuning in. And thank you all for sharing with us. And until next time, you all have a great, great day.